Take that out. So we have been discussing the new lending norms that have been introduced for urban cooperative banks. These urban cooperative banks, as we discussed in the beginning, are a very important part of the banking structure in India. Now, if you look at the banking structure, for example, this banking structure specifically in India has been divided into commercial banks, and then there is a set of banks called the cooperative banks. Let's try and understand what cooperative banks are and how do they work. So I'll start from the beginning, don't worry. Now, if you look at, for example, the cooperative banks in India, how exactly are these banks different? In a cooperative, be it a bank or be it any other organization, in a cooperative, you usually are a member and not an employee. Think about it. In a common bank, usually there is the CEO, there is a chairman, the MD. They will be the one who will take most of the important decisions. They will be the one who will decide how the banks run. On the other hand, if you are in a cooperative bank, in the structure of the cooperative bank is that in this specific part, the people are members as well as customers. So in a cooperative, usually the same person is a member of the bank and the same person is also the customer in the bank. So what the bank is doing is it is mostly offering its services to the members. They are no employees, they are usually members. So what happens in these cases in cooperative banks, they are not looking to maximize their profit. In a cooperative bank, the idea specifically is to make sure that we serve the underserved areas. The idea is not to have profit maximization as such. This is where these are different. There are rural cooperative banks and there are urban cooperative banks. The urban cooperative banks are usually targeting semi-urban areas, areas that usually do not have a lot of other commercial banks offering their services. Now, because they don't aim for profit maximization and because they're specifically targeting areas that are under some kind of a stress and they don't have a lot of banking facility, RBI has some special provisions for them. For example, most of their loans have to go out in priority sector lending areas only. So priority sector lending areas basically are those areas which we discussed in the last class on Saturday as well, where the loans have to go for building social infrastructure, where the loans have to go for education purposes, for affordable housing, etc. All this is what urban cooperative banks usually do. Now, urban cooperative banks, as I said, it is in the news because RBI has made it more flexible, has made it easier for them to give the loans now. Now, giving out the loans for urban cooperative banks has always been a kind of a dicey situation because, as I said, number one, they mostly focus on the members rather than customers. They mostly focus on the members, that is, the people who are kind of a part of the infrastructure of the bank. These are the people who are pulled in their capital to get the bank started. Secondly, they also are under a lot of regulations by the RBI. RBI tells them how can they give a loan, who can give a loan, who cannot give a loan. All these things are decided by the RBI. Now what RBI is doing is they are relaxing these norms, allowing them to give out more loans in an easier manner as compared to the other banks. Now, these are the urban cooperative banks. If you look at their history, these banks are very, very, very old. It is the British who introduced the idea of cooperatives, especially the cooperative banks in India. For example, if you go back, the first of all these, that is the first urban cooperative credit society, was established in 1889 in Baroda. So it's extremely, extremely old. It is again goes back to something that goes back to the British era. The Cooperative Credit Societies Act of 1904 was passed. Under these, the cooperatives were established. Again, there are different types of cooperatives. You will see cooperatives in the field of agriculture. For example, for milk production specifically, the government of India tries to make sure that cooperatives are the ones that work in this area. Amul is a brilliant example of how a cooperative has been successful in bringing the farmers together and work to sell the milk together. Similarly, in the banking sector also, while lending activities or account opening, the government wants to ensure that cooperative structure is the one that is given a boost. The difference between a cooperative bank or a cooperative organization as compared to others, as we discussed earlier, is in a cooperative bank, the people are not usually employees, they are members. and the same people are usually customers as well. So they are the ones who are looking into the working of the bank. You will not just take a loan from the bank, also you will have a part to play in deciding how the bank will work, how the bank will function. This is where it is slightly different. Now, the urban cooperative banks thus have a unique kind of a banking system wherein they serve mostly the underserved areas. This is the regulatory framework. Because they are cooperatives, there is a dual control over them, not just the RBI. So in a commercial bank, for example, RBI alone will have the control. But in these kind of banks, they are under dual control. One, they are under the Banking Regulation Act because they have to give banking services, so they are registered under this. About their licenses, how much capital would they need to have, all that is governed by Banking Regulation Act. On the other hand, because they are a cooperative, they also are under Registrar of Cooperative Societies. So Registrar of Cooperative Societies also make sure that there are certain regulations that are put in place for urban cooperative banks specifically. So these are, again, there is a dual control over these banks. The problem here is, if you have these kind of controls, if you have dual control, for example, there are more than one organization that are actually regulating your working, it becomes slightly problematic, it becomes slightly more complex for these kind of banks, because this is where the banks usually will have to comply with a lot more regulations as compared to the other banks. This is where it's not that easy for them. Now, urban cooperative banks are put into 4 tiers or 4 categories. That mainly is dependent on how much deposit do they have. So depending upon the size of the bank, there are usually different tiers. For example, the tier 1 urban cooperative banks are the lowest one. They are the banks who have a deposit of up to 100 crore. So up to 100 crore deposit, if you get, you will become a tier 1 urban cooperative bank. If you have a deposit between 100 and 1000 crore, you will be called a tier 2 urban cooperative bank. Then 1000 to 10,000, you become a tier 4 urban cooperative bank, and tier 3 rather, and tier 4 is urban cooperative bank with a deposit of over 10,000 crore. The government, the RBI specifically, has put them into these categories so that they can look into the working, they can put regulations over their working depending upon their size. Because the idea is, when you are such a huge bank, when you have deposits over 10,000 crore rupees, that means the point here is that if you go bad or if something wrong happens in your working, a lot more people will be affected here as compared to if you are a tier 2, tier 3 or tier 1 bank. So the RBI's regulations are different for these banks depending upon which category they are in, and that mainly depends upon the kind of deposits that they carry with them. Now, coming to why is it in the news? As we said, the reason why it is in the news is the new lending norms. Now, what exactly are the lending norms here? What is it that they have to look into? So there are 3 categories of lending norms or the new norms that have been introduced. That is why it is in the news. First category of norms is about small value loans. Now, what is it? So RBI now says that at least 50% of total loans and advances should consist of small value loans by March 31st, 2026. So at least 50% of your loans that you are giving out should be under the category of small value loan. Now, what exactly are these small value loans? Small value loans are those that are defined as loans which do not exceed 25 lakh rupees or 0.4% of tier 1 capital of the bank, whichever is higher. If you remember, we had discussed earlier about the different tiers of capital that the banks have. Tier 1 capital is the purest capital or the capital that is most immediately available to the bank. This is a capital that the banks can immediately use if they have some kind of a loss to compensate for that loss, etc. So a loan that is below 25 lakh or up to 0.4% of their tier 1 capital, whichever is higher, maximum ceiling is 3 crore rupees per borrower. That will be a small loan. At least 50% of the loans of urban cooperative bank have to be small value loans by the end of March 2026. Then the boards must periodically review loan portfolio behavior and quality. So the board of the bank itself, not the RBI. The urban cooperative banks, they would have a board of themselves. Every bank has a board. Their board must periodically make sure that the bank quality, the loan quality is reviewed. They will look into whether the loans that are given out are correct or not. Second category of reform is about real estate exposure limit, means how much loan should be given for real estate purposes, etc. So the urban cooperative banks can now exceed the 10% ceiling on aggregate exposure to housing real estate. So earlier there was a 10% limit, means not more than 10% of the loans or the loan value from the urban cooperative bank should go to real estate projects, means housing and land buying, etc. Now that limit doesn't exist. You can go beyond 10%. Also, commercial real estate loans by additional 5% of total assets can also be increased. So 10% limit has been removed. Also, you can go for commercial borrowings for commercial real estate, that is for buying a shop or for business expansion, etc. There is 5% more that you can give out. Apart from that, prudential limits on housing loans under UCB, that is tier 1 banks can give up to 60 lakh rupees for a housing loan. Tier 2 banks can give up to 1.4 crore rupees for a housing loan. Tier 3, 2 crore rupees, and tier 4, 3 crore rupees. If you remember, we just discussed what are the different tiers of urban cooperative banks. The highest is tier number 4. Fourth tier is the bank that has a deposit of 10,000 crore or more. So if you're a tier 4 urban cooperative bank, you can give out more housing loan or more amount in the housing loan. And as you go down the tiers, you can give lesser amount of money in the form of housing. These are all new guidelines issued for them. Then there is a guideline about aggregate exposure restrictions. Total exposure of a urban cooperative bank to residential mortgage, that is housing loan, other than priority sector lending, should not be over 25% of their entire loans. So other than the priority sector lending loans that they have given for housing, etc., other housing loans in total should not be over 25% of the total loans that they have given. Aggregate exposure to real estate sector, housing loan and individual excluded should not exceed 5% of their loans. So apart from housing, etc., the other real estate loans that have been given should not go beyond 5% of the total loans. These are the new norms that have been released by the RBI for urban cooperative banks for the purpose of loans, that is lending. So how can they lend the money, how much money can be lent, in what sector can it be lent, all of these things are decided here or can be or have to be adhered to as per these guidelines given by the RBI. This is the structure of the banking structure of cooperative banks in India. As we discussed earlier, there are commercial banks, there are cooperative banks. Cooperative banks also are rural cooperatives and urban cooperatives. Rural cooperatives then have many other branches, short-term structure, long-term structure of loans. We are discussing here the urban cooperative banks. So there is no sub-part of urban cooperative as such. The lending norms that we discussed were specifically for the urban cooperative banks. This is what the RBI has told. Also, this is the difference between a commercial bank and an urban cooperative bank. As I told you earlier, the biggest difference is in the ownership. So in a commercial bank, when I say commercial bank, these are SBI, HDFC, Bank of Baroda, etc. Commercial banks are owned by shareholders, public or private entities. While here in urban cooperative bank, they are controlled by members, and usually these are the ones who become customers as well. They have dual control, RBI, Registrar of Cooperative Societies. On the other hand, they are only controlled by RBI. Profit is not the first motive of urban cooperative banks. The motive is mainly to cover as much population as possible to cater to their banking requirements. For commercial banks, profit is the driving force behind their working. The lending focus, especially here, is of the weaker section of the society. For here, the lending focus is mainly on retail banking or commercial projects, etc. And most importantly, because the ownership structure is different, the right to vote, to take important decisions. The voting right in urban cooperative banks is one member, one vote, while in a commercial bank it's different. For example, in a commercial bank, your vote, even if you, for example, let's say have some shares of HDFC Bank, they will not ask you for your vote when they are taking an important decision. The board of directors, they are the ones who will decide how the banks will function. So they don't function on the basis of one person, one vote. Your status in the bank decides your voting value in a commercial bank. In a cooperative bank, there is one member, one vote. That is also because of how different the ownership structure is and how the ownership is defined in these banks. This was our first topic for the day. If you understood this carefully, let's see if we can answer this question. Read it carefully. Read it carefully and make up the answer in your mind. Let's see if you can answer this. Done? If you need some more time, you can pause on this screen. You can pause on the screen. All right. With reference to new lending norms of urban cooperative banks revised by Reserve Bank of India in Feb 2025, consider the following statements. Number one, definition of small value loans have been revised to include loans up to 3 crore or 0.4% of tier 1 capital, whichever is higher. We did discuss this, that small value loans that should contribute a major portion of the loan. This is how these have been defined, that small value loan means loans which are up to the upper limit basically is 3 crore or 0.4% of the tier 1 capital. That is the upper limit. Second, housing loans under priority sector lending are now exempt from commercial real estate exposure norms for all tiers of urban cooperative bank. This is correct. Priority sector lending loans, those loans are not called as commercial real estate exposure. So that allows the banks to give more loans to commercial real estate so that they can earn more interest there. Third, the real estate exposure limit for urban cooperative banks has been increased from 15% of total assets with additional 5% for individual housing loan. No, if you remember, this used to be 10%, but now the RBI says that even the 10% limit can be breached. So they have not put the 15% limit mark. They have said that the limit is 10%, but they can breach it. And they have said apart from this, 5% additional can be for individual loan. That is correct, but this is not correct. Third is wrong. Fourth, urban cooperative banks must ensure that 50% of their loan portfolio comprises small value loans by March 31st, 2028. See, this part is correct. The RBI wants that half of their loan portfolio should be small value loan. That is correct. But is it by this date? No. It is by end of 2026 March, not 2028. So by the end of March 2026, they would have to get half of their loans in the category of small value loans. It is not by 2028. So fourth is also correct. Fourth is also wrong. Third was also wrong. Which of these is correct? Then 1 and 2. Answer then would be B. B would be the correct answer. 1 and 2 here are correct. If you want, you can take a screenshot from here to help you revise later on. Moving on to the second question based on this topic. Read this carefully again. Let's see if we can answer this. Read this carefully. Make up your mind what should be the answer here. All right. Consider the following statements regarding new lending norms for urban cooperative banks and their implications. First, the RBI has doubled the housing loan limit for tier 3 urban cooperative banks to 2 crores to address rising real estate costs in urban areas. We did discuss the limits have been increased. There is a limit depending on which tier the bank is from. For tier 3 banks, the limit now is 2 crore, that is correct. So up to 2 crores of home loans they can give. Second, urban cooperative banks are now permitted to charge foreclosure penalties on floating rate interest loans to mitigate prepayment. That is wrong. A lot of information here. First, what is foreclosure? Foreclosure means when you close the loan early by giving all the money to the bank. Let's say I have a home loan that is pending. I give EMIs every year. 2 or 3 years are still left, but I have bulk money. I give it to the bank all at once to close the loan so that I don't have to pay the interest for such a long time. That is called foreclosure. In most cases in banking loans, foreclosure does not get any penalty. So there is no penalty for foreclosure, number one. Secondly, if you actually see, floating rate means in banking loans or in housing loans, usually these are floating rate. Floating rate, what do you mean by this? These are not fixed rates. These are rates that are decided by what happens at the level of the RBI. So the RBI, for example, if they increase or decrease their repo rate or reverse repo rate, on the basis of that, the banks will also change their rate. That is called a floating rate. So this is wrong. There is no foreclosure penalty for a home loan. So second is wrong. Third, the revised norms mandate quarterly compliance report for small value loan portfolio starting April 1, 2025. Means every quarter there has to be a report given about the loans that are outstanding. That is correct. So that there is a check that is kept on them. And then the next one is, as per Economic Survey 24-25, the new lending norms have increased their contribution to 65% of the loan portfolio. No, the Economic Survey does not give this specific number. It does not give this specific number. Now, if you look at this, and I see some people have answered this, but if you have decided the answer, first tell me, did you read this word or not? If you made up the answer in your mind and I'm glad that you are actually participating and answering in the chat, but first tell me this, did you consider this word or not before making up your mind about what the answer is? Because if you did not consider this word, that they're asking you which of these is not correct, most probably you would not have gotten it right. So since they're asking which of these is not correct, the answer becomes 2 and 4. That is A. That is why, and I've been telling you this for a very long time, even if you know all the statements, it is not enough. You have to read the entire question carefully. If the question is asking you which of these is not correct, the answer then becomes A, 2 and 4. If the question would have been which of these are correct, then the answer would have been 1 and 3. So the answer here is A. I hope you got this one right. You have to choose which of these is not correct. Okay. If you want, you can take a screenshot here for revision purposes. Just take this if you want to revise it later on. All right, then moving on, I now have a related previous year question, a topic that is related to this from where UPSC has already asked a question. This is in 2021. 2021, there was a question straight away from urban cooperative banks. Let's see if you can answer this. Read this carefully. With reference to urban cooperative banks in India, consider the following statements. First, and okay, I'll give you some time. Think about the answer. First, decide what the answer should be. And after that, you can play. So first, they are supervised and regulated by local boards set up by the state governments. Are they? No. We discussed that their regulation is of dual structure. There is RBI and there are cooperative societies. But no, it is not the state boards that actually go over and regulate them. State boards do have a role to play in rural cooperative banks, but in the urban cooperative banks, no. They can issue equity shares and preference shares. Yes, they can. They can issue these kind of shares to their shareholders who are bringing in more money. They are brought under purview of banking regulation in 1949 through the amendment in 1966. Yes, we did discuss they are under the Banking Regulation Act because at the end of the day, they are a bank. So they are under these regulations. They are under regulation of RBI as well as the cooperative societies. So the answer here would be B, 2 and 3. This was not a difficult one. This was asked in 2021 and you should be able to answer this one. B is the correct answer. to this particular question. Again, if you wish, you can take a screenshot so that you can revise it later on. All right, then let's move on to the next topic. The next topic that we have is called Willful Defaulter Framework. Now, what exactly is this? Why it is in the news? Let's first try and understand the idea of willful defaulter. We have discussed already about things such as NPA, non-performing asset. We did discuss about SMA, special mention account, also in some of the earlier classes. Related to that, there's something called a willful defaulter. Now, when you take a loan from the bank, there can be 2 or 3 situations here. One, you just pay the loan back as per the agreement, as per your promise. That is one part. Second option can be, or second, let's say, prediction can be that maybe you don't have money now. Let's say you took a loan for the business, your business faced a lot of losses, now you don't have any money to pay back. Then your loan becomes an NPA. There's nothing much that you can do. The bank or the insolvency professional will take over the assets of the company. They will sell the assets of the company so that whatever loan the bank can recover, they will do that. That's the second option. However, there's a third option as well. The third option or the third prediction may be, let's say there's a person who has the money to give back, but they are not giving the money back to the bank. Then you will be called a willful defaulter. So please understand, a willful defaulter and an NPA loan is not the same. NPA, the loan becomes an NPA when you don't have the capacity to pay. That is fine. In that case, your personal asset, etc., will not be taken away from you. We discussed the idea of limited liability partnership. If you have taken a loan for the banking purposes, for your business purposes, it is only a business asset will be taken away, not the personal asset. But when you have the capability, the capacity to pay back, but then you are not giving back, that makes you a willful defaulter. Now, for willful defaulter, you will see, for example, I don't know if you have noticed or not, sometimes in the newspaper, there are certain ads by the banks where they publish photos of certain individuals. And they say that this individual took a loan from us and they are not giving us back. Or they publish the names of the individual. The name publishing or name and shame kind of a thing is for the willful defaulters only. It is not for those who now have suffered so many losses that they can't give the money back, or something wrong has happened in their life and they can't give the money back. It is not for them. The willful defaulter thing is mainly specifically for those who are right now in this situation because they can give the loan back but they are not giving back. Now, RBI has issued some directions of how to deal with willful defaulters, what the banks can do, what the banks cannot do. I'll also remind you once again of an important fact that we discussed. Just to make it clear, we did discuss about NPAs, that is non-performing assets of the bank. In simple terms, when the bank gives out a loan and for a 90-day period, at least for 90 days, the bank has not received any money back, neither the interest nor the principal, then that becomes an NPA, non-performing asset. Okay. Before that, the bank first categorizes these into special mention account, SMA. There is SMA 0, SMA 1, SMA 2. SMA 0 means when there is no payment that has come in, it is due for over 30 days. When the payment is due for 30 to 60 days, it is SMA 1. When it is due for 60 to 90 days, it becomes SMA 2. And after 90 days, it becomes NPA. One more thing, just to remind you, we discussed this earlier. Right now in India, NPAs are at their lowest point in the last 12 years. Gross NPAs in India have now reached 2.6%, which is the lowest point in the last 12 years. So we are doing well. To do even better, to reduce these dead loans or NPAs, for this specifically, the RBI has now brought up this new willful defaulter framework. So, willful defaulter, as I said, a person becomes a willful defaulter when they have the capability to pay the money back, but they're still not giving it back. Now, this framework that the RBI has released applies to banks, NBFCs and other institutions that give out loans. Now, they basically extend the reporting requirement to asset reconstruction companies and credit information companies. So, the banks, for example, will have to inform very, very promptly about something like this to credit information companies. We discussed about these earlier. Remember CIBIL, Experian, what they do is they try and maintain a CIBIL score. They try and maintain a credit score for us. So these companies have to be told about willful defaulters, number one. Secondly, they also have to inform asset reconstruction companies. Again, something that we did discuss. These are also called bad banks or asset reconstruction companies that will take over the loan from the bank and then try and recover that. Bank will be given some part of the money. There are provisions related to large defaulters and how these defaulters and companies related to them will not be given loans in the future. These are some of the regulations that RBI has come up with. Also, the RBI has said that lenders must complete the classification of a borrower as a willful defaulter within 6 months of it being designated as an NPA. Means, once a loan becomes an NPA, NPA loan can be of two types. One, as I said, the company or the person does not have any asset left to give the money back to the bank. That is one situation. Where they don't have anything to give back, there is just no option available. That is fine. But the second option is when they did have the money to give back, but they're still not giving back, that is the willful defaulter. In the willful defaulter situation, this is where the non-performing assets has to be converted into a willful defaulter. So the RBI says that after something becomes an NPA, within 6 months, the bank has to then classify that into a willful defaulter category. Apart from that, there are other criteria also that are required for a willful defaulter. For example, if a lender gives a loan or concessions based on the borrower's or promoter's commitment to infuse equity and they have not done that, then also it should be called a willful defaulter. That was not a criteria earlier. Means if someone took the loan from the bank in exchange for a promise that after 3 months, 4 months, 6 months, I will give the bank a part of my company. My equity in the company I will transfer to the banks. But they have not done that as well. Then in that case also they will call it as a willful defaulter. Also, the loan agreements that are done must include a clause stating that borrower shall not induct a person listed as a willful defaulter to the management. Means if a loan is given to a company, the company must also write in the statement or in the agreement that we promise the bank that any person who has been a willful defaulter in the past will not get a management position in the company. Because once a willful defaulter is a part of your company's management, there is a higher chance that you will also do the same as the person did. Lenders cannot renew, enhance, provide fresh facility or restructure the existing facilities for a borrower if a promoter, director, person charged remains a list of willful defaulters. So if a company again is run by a group of people and any one of them is a willful defaulter, then the loans given out to the company cannot be restructured by the bank. No changes can be made in the bank. The tenure cannot be extended. They cannot have more loans given out. So all these restrictions are put on them in case the companies are run by those who are in the list of willful defaulters. Apart from that, the companies that are associated with willful defaulters will have these restrictions. First, your new loan facility will not be given to them. If a willful defaulter is a part of management, forget about any new loan. Second, even if you remove the person from the list, after that you will have to wait for 5 years for floating any new venture to actually give out a loan or take a loan. So even if you remove the willful defaulter, you have to wait for 5 more years. Any existing loan can be restructured from a company only 1 year after you have removed the willful defaulter from your management. So again, the RBI has taken a very, very strict look at how the willful defaulters are still a part of some businesses. If any businesses engage the services of willful defaulter, even after knowing that they are in the list, the company's credit lines, etc., will have to suffer considerably, and it will be very, very difficult for them to actually get a loan. Now, apart from that, the lenders must have a board approved policy covering constitutional identification of review committees. Apart from that, compromise settlement with willful defaulters. At what rate will they compromise? Because see, the banks also, when they know that the money is not coming back, they will have to compromise. So compromise means the banks saying that okay, I'll take lesser amount of money, you pay the loan back, whatever you can. These have to be reviewed by the committee. Also, there has to be threshold, there has to be a forensic deposit done against the willful defaulters. There has to be specific guidelines written by the bank's board of circumstances under which they will be ready to compromise with the willful defaulter. How can they extract most of the money back? And this is where we discussed this earlier. Credit reconstruction companies or what you call as bad banks, they play a very crucial role. They take over this load of NPAs, etc., from the banks, and they tell the banks that you focus on the banking operations, we'll try and extract the money out of it. Anyways, if you understood this, let's see if you can answer this question. It's a long one. Read it very carefully and see if you can answer this. Done? I hope you have read this. I'll give you a few more seconds. It's a long one. All right. With reference to RBI's willful defaulter framework, consider the following statements. Number one, a borrower can be classified as a willful defaulter if they fail to infuse committed equity despite having the capacity to do so as per 2024 master directions. Exactly what we discussed, that in certain cases when someone takes a loan from the bank, they promise the bank that I will give a part of my equity to you. If they do not do so, if they have not done that, then that is wrong. In that case also, they will be called as a willful defaulter. Second, the first is right. The identification committee must complete the classification process within 3 months of an account being declared as NPA. What did we discuss? Is it 3 months? No, Tejaswini is absolutely right. This is 6 months, not 3 months, within 6 months. So, when the account becomes NPA, when the money has not come back in 90 days, after that, within 6 months, the banks have to now complete the entire process of naming the person as a willful defaulter. Lenders are prohibited from granting credit facilities to entities associated with willful defaulter for 1 year after removal from the list of willful defaulters. Yes, that is correct. Even after the person has been removed from the list of willful defaulters, you have to still wait for 1 more year to give the loan. Framework mandates the photographs of willful defaulters to be published only with the approval of the Supreme Court. No, not the approval of the Supreme Court, that is not required. The approval of the board. So, the bank will have a board. The approval of the board is required and not the Supreme Court. So, fourth is wrong, second is wrong, 1 and 3 are correct. The answer becomes B. B is the correct answer here, 1 and 3. I hope you got this one right. If you wish, you can take a screenshot here to revise it later on. Then the next question. Again, read it carefully, see if you can get the answer here. Done? Alright. Consider the following statements regarding willful defaulter framework and its implementation in India. Number 1. The 2024 master directions apply to all RBI regulated entities, including NBFCs, of the middle and upper layers for identifying willful defaulters. Yes, we did discuss this. These guidelines are not just for the banks, all the entities that come under RBI that give the loans like NBFC, etc., all of them have to adhere to these guidelines. So first is correct. Second, a guarantor who fails to meet invoked guarantee obligation despite having the means is exempt from being classified as a willful defaulter. Now again, let's try and understand this first. Who is a guarantor? When you take a loan from the bank will ask you, bring a guarantor with you. A guarantor is someone who guarantees the bank that don't worry, even if this person does not pay the loan back, I will give the loan back. It is my guarantee. It will be my obligation. That is a guarantor. Now, consider a situation where the person has not given the loan back, who has taken the loan. It will now fall on the guarantor. If the guarantor also does not pay the loan back, although they have the capability, guarantor has the capability, but they are also not paying the loan back, then they will also be called as willful defaulter. So being a guarantor is not just on paper. If you are a guarantor, then you also have to make sure that your guarantee is fulfilled. You became the guarantor because you trusted the person. Now he is not giving the loan back, so you must. If you are also not giving the loan back, if you can afford, then you are also called as willful defaulter. So second is wrong. Third, the lender must report large defaulters with outstanding amounts of over 1 crore and above to Credit Information Company monthly. Yes, that is correct. Credit Information Company, as I discussed, CIBIL experience that maintain your credit score. In common language, we call it the CIBIL score. CIBIL is a company that maintains that. Fourth, as per the Economic Survey 24-25, willful defaulter framework has reduced NPAs by 25%. No. So as I said, NPAs have been reducing, but it is not, the Economic Survey doesn't say that is because of this framework specifically. That is not the case. And once again, I'll remind you, you had to choose which of these is not correct. And I'm very sure someone here did not read this word. So since you had to choose which of these is not correct, the answer then becomes 2 and 4, that is A. 2 and 4, that is A. So you have to choose the incorrect ones, the statement that are not correct here. Out of the 4, 2 statements are not correct. A would be the answer here. The other 2 here are correct. Okay. I hope you got this one right, and I really hope you read this word not. Got it? Perfect. If you wish, you can take a screenshot here. It will be helpful for your revision. All right then. Once you have done that, I have a related previous year question here as well. Let's see if we can answer that question, something that has been asked, that was asked in 2020. Let's see if we can answer this. It's slightly related to what we discussed, not exactly, but slightly related to loans given out by the banks. Read this carefully, make up your mind what the answer should be. Think about what the answer is. All right. What is the importance of the term interest coverage ratio of a firm in India? First, it helps in understanding the present risk of a firm that a bank is going to give the loan to. Yes, that is correct. It helps in evaluating the emerging risk of a firm that a bank is going to give a loan to. Yes, that also is correct. Third, the higher a borrowing firm's level of interest coverage ratio, the worse is the ability to service its debt. No, it's the opposite. So what exactly is this interest coverage ratio? So basically, when the banks give a loan to the company or to a firm, they will have to assess what is the earning of the firm and how much earning is going to increase. Depending upon their present earning and the future prediction, the bank then has to take a call about whether is it enough for them to pay the interest of the loan that we are giving. So if they have a higher earning, that means that there is a good chance that they will be able to pay the loan back. If they have a lower learning assumption of if the prediction is lower earning, then they cannot give the loan back. So higher interest coverage ratio means good for the bank. That means there is a higher chance that the bank will be able to get the money back. So third is wrong. The higher the level of the interest, higher the level of the interest coverage ratio is, the better it is the better is the ability for them to pay the loan back. So third is wrong, first and second are correct. The second is, third is wrong, as I said. 1 and 2 are correct here. A becomes the correct answer. 1 and 2 are correct. The third statement here is wrong. Okay. So the interest coverage ratio basically determines, is your earning enough to cover the interest of the bank, the interest that will be charged on the bank's loan, is it enough to give the money back to the bank? If you understood that, let's move on to the next topic then. The next topic that we have is the credit rating agencies. Now, please do not confuse credit rating agencies with credit information companies. Credit information companies are different. The credit information company like CIBIL, etc., the credit bureau as it is called, that is very different. The credit information companies, credit rating agencies are different. So what do? You might have heard these kind of terms like a bond has AAA rating or a bond has BB or BB minus rating. You might have also heard about certain organizations such as Standard & Poor's, that is S&P, Moody. You might have heard of these international organizations. Now what do? These are credit rating agencies. So what do basically is, they look at, let's say, different institutions around the world, including governments. So they look, let's say, at the Indian government, the working of the Indian government, how much loan the Indian government already has, how much are we paying back, at what rate are we paying back, what is our earning, what is our financial ability, everything they will look into, and then they will give a rating to Indian government or the Indian government bonds. So if they give a rating, for example, of AAA, which is the best one, what they mean to say is, if anyone takes or buys the bond of Indian government, it is almost 100% certain that they will get their money back. It is the safest kind of investment. When your credit rating starts to go down, let's say something like AAB or ABB or ABB minus or something like that, all of them have a different type of a pattern. But when your credit rating starts to go down as a nation, then it will be more difficult for you to sell your government securities to international investors especially, because what it indicates is that the loan that the government is taking may not be given back. So the higher the rating, the safer your loan is considered, the safer your bonds are considered, so investors can come in and bring their money. The lower the rating, the lower are the chances that they will get their money back. Now, there are many of these companies or agencies that give these ratings, and the ratings are not just given to the governments. They can also give rating to companies. Like, corporates also, they issue their bonds when they have to take out loan or money from the market. They also issue their bonds. So these credit rating agencies basically do this job, that they give these kind of credit ratings. Now, we already have many of these. The problem was that most of these all of these were not Indians. All of these are foreign companies. When these foreign companies give out these rankings, Indian government always had this problem. We always complained that they are anti-India. We always complained that the rating agencies or the ratings that they are giving to the Indian bonds especially is biased. They don't consider a lot of factors, and that is why India for a very long time has been trying that why not have such kind of an agency that is from India, so that we can also do the same. And this is where the news is. The news is that CareEdge has launched first ever sovereign rating report. Now, what is CareEdge? CareEdge is again the first Indian credit rating agency that has been now giving ratings to other countries as well. Because all these Standard Poor, Moody's, etc., these are private companies. They are not connected to the government, but they are so powerful that when they give a credit rating, it impacts the country's ability to take money from the market, to take money from the investors. Any downgrade in the rating has a negative impact. Any upgrade in the rating has again a positive impact. So that is why that's the power of these companies. Something that the Indian government also now wants to do, the Indian market also wants to do. So CareEdge, it's an Indian company. They have released these ratings now, and they have also started giving ratings to other countries. So for example, they just gave BBB plus rating to India, Botswana, Philippines. This is the news. The name is CareEdge, that an Indian credit rating agency is now giving global ratings as well. So countries are issued these sovereign ratings. The purpose is that when they will issue the bonds in the market, the securities in the market to take loan, how better or how worse the bond will perform. Because see, it also determines the rate of interest that the nation has to offer. For example, if India is given a lower rating by S&P, that is Standard & Poor, if they give a lower rating to India, means they want to say to the world that Indian investment is not that safe. That means now to attract investors to Indian bonds, Indian government has to increase the rate of interest being offered. Then we have to increase the rate of interest offered so that we can make it more attractive for outsiders, investors to come in and take and bring their money to India. That is a big problem. Offering more rate of interest means you are giving out more money. That is the power that these companies have. Just by downgrading or upgrading the rating, they can have a major dent on the government's revenue, on the government's earning. And this is where now this ranking from India, this rating from India will also do the similar kind of things for other countries as well. These are sovereign credit ratings, means sovereign means given to a country, given to a government specifically. It depends on a lot of factors. For example, the volume of foreign public and private investment in the country, how much investment is flowing in the country, how safe has it been, capital market, how transparent it is, foreign currency reserves, how much reserve the country has. Because at the end of the day, if India has a lot of foreign debt that we have to repay in foreign currency only, we should have foreign currency reserves nearby that number, so that we are able to service our debt. For example, just in India's context, if you look at our foreign debt, the debt that India has taken from outside, and compare that with forex reserves that RBI has. Forex reserves of India are a lump sum 90% of the foreign debt that we have. So for example, if our foreign debt, again I'm not talking about total debt of the government, only talking about the foreign debt. So if the foreign debt of the government, let's say, is $100, then our forex reserve is close to $90 right now, which is a good thing. Obviously, we don't have to pay back all the foreign debt all of a sudden at one go. That is not how it works. It all goes in EMI. But in case if we had to do that, if some situation comes in where foreign debt has to be given back in large amount, we do have the foreign reserves to actually counter that. So this is something that the credit agencies also look into. How much foreign currency exchange do you have? This is what these agencies do. They assess the credit worthiness of the entities. They don't just issue ratings to government. Now this one, the Care Edge has given rating to government only, but the international organizations, as I said, Moody's, Standard & Poor, etc., Fitch, as you can see here, they give ratings not just to the companies. The ratings are given to companies, sovereign, corporates, financial institutions, etc. For example, World Bank also has a rating given by them. So World Bank also has to take money from the market so that they can distribute money to the countries. So when World Bank goes to the market to take a loan, that also is determined by the credit rating that the World Bank has. World Bank is also given credit rating by these organizations. They offer insights into how the country has been servicing its debt. Means it's similar to how an individual would have the credit score. How you and me as individuals would have a CIBIL score, would have a score depending upon that will decide whether we will get a loan from the bank or not. Similarly here as well, these kind of ratings that they give also decide whether the country will be getting loans or not at a good rate of interest, or whether their bonds will be sold in the market easily or not. These agencies have to abide by certain regulations set up by SEBI, because see, their ratings can have a major dent on any corporate. When they give corporates the rating and they reduce or increase the rating, they can have a major impact on the corporates, especially those who are listed in the stock market, in the stock exchange. Their share prices can go up and down, and this is where SEBI comes into the picture. So this is where SEBI has given certain guidelines. First, CRAs, these agencies, need to disclose the probability of a default of the companies that they rate. So when they rate the companies, this can't be random. They have to specifically tell what is the probability that these companies will default on the debt, that they may not give the loan back. They need to be more transparent about their methodologies. They can't be like, we are randomly giving this rating to a company, this rating to a government. They have to be transparent. How do they decide all these things? SEBI has also proposed establishment of a rating subcommittee that will oversee these agencies and monitor their compliance. They have proposed that they also should be held more accountable for their ratings. Again, if their ratings turn out to be false, means if the information on the basis of which the ratings have been given is not the correct information, then that should be taken into account, and these companies also should have to pay some fine for that. SEBI has proposed that these companies should not be permitted to provide advisory services to companies that they rate. Means, for example, let's say they give a rating to Reliance and they say that we are reducing your rating because you have a lot of loan now. So these companies should not do business with Reliance now. They should not advise Reliance that, okay, we will advise you how to improve your rating. No, because that is a very clear-cut conflict of interest. So whoever you are rating, you cannot be an advisor to them. They also need to disclose the extent of their ownership and shareholding pattern in the parent companies. Means who owns these companies? That is Standard and Poor's, Moody, Fitch. Who owns these companies? Who are the owners? Are they, for example, let's take this example. Let's say the owner of one of these credit companies is a person who is in competition with Reliance. Okay? So they would want that Reliance should face losses. They would want that something wrong should happen to Reliance. So they will tell their credit rating company that give a bad rating to Reliance so that in the market the name goes down, the shares go down. So the parent of this credit company will have all the profit. This is where the ownership structure must become transparent. So who owns these parent companies? What is the ownership pattern? What exactly is the business that they do? All that has to be taken into consideration. All that has to be disclosed by these companies. Now, as I told you earlier, credit rating agencies are different and credit bureaus are different. Credit bureaus are the ones that provide information about the past debt repayment. Like we discussed, and we discussed this earlier as well. In real life also, when you go to the bank to ask for a loan, you will hear this word very often, CIBIL. Time and time again, they'll ask you for CIBIL score. What is your CIBIL score? What is CIBIL exactly? The CIBIL score of an individual is on the basis of the past payment record. It is not about the future. Your CIBIL score is built dependent on in the past how much loan did you take, whether you were able to pay the loan back or not. That will determine your CIBIL score. The credit rating agencies are mostly talking about the future. They are saying that we expect that in the future this money will go back or this money will not go back. There's a difference between these two. So don't be confused with that. And on that note, let's see if we can answer this question. Read it carefully, read all the statements and see if you know what the correct answer has to be. Done? Alright, let's see. With reference to credit rating agencies in India, consider the following statements. Number 1. CRAs are regulated by SEBI under Credit Rating Agencies Regulation 1999. We did discuss this. It is SEBI that controls them because whatever they do can have a major impact on the future of certain companies that may be listed on the stock exchange. So that becomes a prerogative of SEBI to regulate them. Second, all CRAs must maintain a minimum net worth of 50 crore rupees as per the revised SEBI guidelines effective from Jan 2024. We did not discuss that point, but if you don't know this, this is wrong. As per SEBI's guidelines, these companies must have a net worth of 25 crore rupees, not 50 crore. 25 crore is the net worth that they have to maintain. Third, second is wrong. Third, CRAs are required to disclose a methodology for their ratings for debt instrument on a public website within 7 days of issuance. That is correct. So whatever methods they use, whatever information they use to decide what exactly will be the rating, and then they publish it, all that methodology has to be made public on their website within 7 days. Fourth, as per Economic Survey 24-25, CRAs have facilitated a 15% increase in corporate bond issuance since 2020. No such figure has been given. The Economic Survey has not given any such figure that because of this much money has been raised or this much money has come in corporate bonds. That is wrong. So the answer here would be 1 and 3A. A would be the correct answer here in this case. Not a very difficult question to answer. I hope you got most of you got this right. A would be the correct answer here. If you want to take a screenshot, you can take a screenshot of the explanation part. Got it? All right. I have one more practice question. Let's see if you can answer that one right. Again, read it carefully. Read all the statements carefully. There are 4 statements in total. All right. Consider the following statements regarding credit rating agencies and their role in India's financial ecosystem. Number 1. CRAs must obtain accreditation from RBI to rate instruments issued by non-banking financial companies. Is that the case? No. These agencies are not related to RBI in any way. They are regulated by SEBI. So it is not that they have to take special permission from RBI just to give a rating to NBFCs as well. Second, SEBI's 2023 guidelines mandate CRAs to publish default statistics for rated entities annually to improve transparency. Yes. Every year they would have to give the data about who are they rating, what is their rating, so that it is all done transparently. Third, the Insolvency Bankruptcy Code 2016. So IBC 2016, if you remember, we had discussed one of the earlier classes as well, relies on CRA ratings to determine the priority of creditor claims during resolution processes. No. IBC does not rely on these agencies and the credit ratings that they have given. IBC has no connection to that. As per RBI's Financial Stability Board, CRA downgrades contributed to 10% decline in corporate bond yields in FY 23-24. No, that is not correct. No such data has come in from the side of the RBI. You have to choose which of these is not correct. 1, 3 and 4 are not correct. The answer here is C. C would be the correct answer. 1, 3 and 4 here are wrong. The second statement is the only one that is correct. IBC does not look into their credit rating or what the ratings they have given to decide what to do with the companies. They are not concerned with that. IBC is only concerned about the payment that has come back and the payment that has a probability of coming back. C would be the correct answer here. If you wish, you can take a screenshot here as well. Got it? Okay, I have a related previous year question. Let's see if we can answer this. It's a tricky one. Prelims 2020 question about Kisan Credit Card Scheme. Read this carefully. See if you can answer this. Read this carefully. under the Kisan credit card scheme, short-term credit support is given to farmers for which of the following purposes. Now, please remember the fact that under Kisan credit card scheme, mainly short-term loans are given. That will be helpful for you to remember the answer. Now, see, working capital for maintenance of farm asset, yes. Working capital means that you require right now, because unless you are given this, your work will stop. Purchase of combined harvesters, tractors and mini trucks. No, that is a long-term loan. See, capital investment is a long-term thing. These loans are not under Kisan credit card. To build an asset, to buy heavy machinery, to buy these vehicles, all of that is capital investment. That is not a part of the money, or that is not something that can be done under Kisan credit card loan. Consumption requirement for farm household, yes, again a short-term requirement. Post-harvest expense, again a short-term requirement. Construction of family house, setting up a village cold storage, again capital expenditure is not covered under this. So capital expenditure cannot come under this. It has to be under other loans that the farmer should take. 1, 3 and 4 is the correct answer. Then B. These are the things for which money can be used when it is given from Kisan credit card. The limit of Kisan credit card has recently been increased to 5 lakh, which is a good thing for the farmers. But again, remember, these are specifically for short-term loans. These are not done for loans for long term. Okay. B would be the correct answer here. If you want, you can take a screenshot from here. It will be helpful for your revision. The next topic that we have here is Investor Education and Protection Fund. Now, Investor Education Protection Fund, basically the simple idea here is a lot of money in India, in banks and other financial institutions, is actually unclaimed. Unclaimed as in, let's assume, I have a question from Tejaswini. Does wage come under working capital? Yes, wages come under working capital. So understand this. For example, let's say that I am a farmer and I have 5 laborers who are working on my field. They will only come if I give them the daily wage. So if, for example, I don't have the money to give them the wage for tomorrow, they will not come. That is a part of my working capital. So working capital would include the wages that I have to give, would also include the input cost that I would entail, cost for buying, let's say money for buying fertilizer, seeds, all of that would come as a part of my working capital. Now, as I said, a lot of money in India is in the form of unclaimed deposit. Now, what are unclaimed deposit? Let's assume there's a family member who had a bank account and most of the family members did not know about that. You know, in the earlier generation especially, the parents would not tell a lot of things, financial specialists, to the children or the next generation, they would not know. Now, if a family member who had this bank account, who had some savings, passes away, their account, the money in their account, for example, is unclaimed. No one knows about that money, that is just kept there. It is kept with the banks, but no one in the family knows about this, so this basically becomes unclaimed. Now, this is where a lot of unclaimed deposits increase, and this is where the government and the RBI have been trying to control that. So, Investor Education Protection Fund basically is that kind of a fund where you can go and check if there are unclaimed deposits that may belong to you in some cases, maybe because of some connection of the family members, and then you can claim those. This is the job of the Investor Protection and Education Protection Fund. What they have done is to get access to them was not easy because of some language roadblocks. So now they offer multi-language IVRS, means if you call them, they can answer in multiple languages, and you can now get information from them in a much better manner. That is the idea. Now, if you look at the history of this, it was in 2016 that it was set up, especially by the Ministry of Corporate Affairs, for investor protection, for financial literacy. The idea is unclaimed dividends that you have. So, dividends that the companies gave. So, what exactly are dividends? Let's say you invested in a company's stock, the company earned a lot of profit in a financial year, and they decided that a part of the profit should be given back to the shareholders. But somehow they did not have the bank account details, somehow they did not get the information, So you were not given that money, you did not even claim that. That is unclaimed dividends. Matured deposit, debentures, money due for refund, interest on unclaimed amounts, all of this that should be your money, that should be in your account, that has not been claimed somehow, to get them back to the person where it belongs to get them back to the person who should own them. That is the job of this investor education protection fund. Now, one critical thing here, you might assume that something like this will be run by Ministry of Finance, which is where you will be wrong. So remember these informations, that this is run by Ministry of Corporate Affairs. This is not run by Ministry of Finance. This is where it is slightly different. The objective, as you can see here, is number one, to get refund of unclaimed funds to the investors who actually invested the money and they don't know how to get it back. To promote investor education, make them more aware. Any disgorged funds should be distributed as per the court order. Now, what is disgorged amount? Disgorged amount basically is a fund that you get from illegal means. So, any money earned through illegal or ill methods, from ill activities. So, how would that money be distributed? That has to be distributed as per the court's order, but it should not just keep on lying in the account. Also, reimbursement of legal expenses of any action class suit, all of that will be a part of what you call as the objective of investor education and protection fund. Now, it is in the news because some of the amendments or some amendments have been introduced here. Tejaswini is asking, RBI also has a portal named Udgam for unclaimed deposits. So, Tejaswini is slightly different. So, what you are talking about the RBI portal, that is mainly about the money in the bank account after the person has passed away, the money not being given back. This fund is specifically for the investors. So, the money that you had invested, not that you had put in the bank account. This is the money that someone in your family, for example, would have invested and now they have forgotten about it or they have passed away. You might have seen a lot of news stories where someone calls and says, my grandfather bought this share. Now I don't know how much this share is worth. My grandfather has passed away. I saw this in his cupboard yesterday. What is the worth? How can I get the money back? This is where this kind of fund will come in. So this is specifically for the investors part. What you are suggesting is for the bank account that have been opened, the money that you had put in specifically in the bank. Now, this amendment that has been introduced recently enables that the public sector bank should transfer any unclaimed shares to this fund, and this will then be transferred to the people who actually make claims for it. Right now, currently, there is a section that allows the transfer of unclaimed dividend but lacks the provision about unclaimed shares. So, the shares that are not claimed, again, if someone in your family had earned some shares or had bought some shares, they have passed away, now no one is claiming those shares, that will also be transferred here. Not just the dividends earned, means the commission earned, the share also, the ownership of the share will also have to be transferred to this fund, and then they will get it transferred to the person who is concerned. Read this statement or read this question carefully. Let's see if we can answer this. It's a long question. See if you can answer this. With reference to investor education and protection fund in India, consider the following statements. Number one, the fund is established under Section 125 of Companies Act 2013 to manage unclaimed dividends and matured deposits remaining unpaid for 7 years. Yes, that is correct. The 7-year period has to be completed. After that, if they have not been claimed, then the fund will come in. They will get it transferred. IEPF authority is chaired by the Secretary of the Ministry of Corporate Affairs with the Joint Secretary as a CEO. Yes, that is also absolutely correct. As per IEPF authorities Jan 2025 guidelines, companies must transfer shares to IEPF within 30 days of 7-year unclaimed period. No, within 90 days. So once the 7-year period is over, means now we have determined that yes, this is a fund that has not been claimed, it has to be transferred. Within 90 days it has to be transferred. So third is wrong. Economic survey reports that the IEPF has refunded 10,000 crore to investors since its inception. No, no such data has come out. We do have government reports saying that a lot of money has been transferred back, but how much, there is no clarity on that. So 1 and 2 are the only correct statements here. B would be the correct answer. B is the correct answer here. 1 and 2 are correct. You can take a screenshot from here if you wish to. That will help you revise later on. All right, next question. Read this carefully again. Think about the answer. Consider the following statements regarding Investor Education and Protection Fund and its role in India's financial ecosystem. Number 1. The IEPF has or can distribute disgorged amounts to investors who suffered losses due to securities law violations as ordered by a court. Yes. As we discussed, it has to be basically as per the court order. So if the court basically does order this, then yes, it can be done. The Niveshak Didi initiative launched by IEPF Authority in 2024 trains urban women as financial educators. No, it is for rural women especially. Rural women and also especially those who are working in the postal sector. So rural postal women basically, they will be the one who will be turned into financial educators so that then they can now come in and promote digital banking. Companies failing to transfer unclaimed amount to IEPF within the stipulated time period face a penalty of 10 lakh rupees. That is correct. As per RBI's financial stability report, IEPF strengthened investor confidence, reducing equity in the market volatility by 5%. No such data has come out. You have to tell which of these is not correct again. So not correct means 1 and 3 are correct, 2 and 4 are not correct. A would be the answer here. Okay, A would be the answer here. Again, you are not reading the not part. Okay, I have a question here. How to tackle these kind of questions where we are not sure of the information released by the economic survey. So, see, in most of the cases, economic survey obviously has a bunch of information. You can't really remember all of that. But in most cases, remember, very state specific or very specific information about a data or about one specific scheme is usually not in the economic survey. So economic survey mostly has a lot more information about, let's say, macro data. Overall economy, overall import, overall export, overall GDP growth is their main focus, especially focusing on one specific scheme. That this scheme has released this data is usually wrong. Again, I'm not saying always. The best way is obviously to know this is right or wrong. But if you really have to make a guess, then in most cases, they will not tell that specifically from this particular scheme this much impact has happened. That is usually not how economic survey gives out the data. This is the explanation part. If you wish, you can take a screenshot to revise later on. Let's go ahead with a previous year question of 2019. Let's see if you can answer this. Read it carefully. It's about what you call as CAMPA funds. So when a company undertakes deforestation of a land to set up an industry, they have to compensate, put some money in a fund called the CAMPA fund. This is what the question is about. Consider the following statements. Number 1. As per the law, Compensatory Afforestation Fund Management and Planning Authority, that is CAMPA, exists both at national and the state level. That is correct. People's participation mandatory in the compensatory afforestation program carried out by this fund act? No. People's participation is not mandatory. It is advisable that people's contribution should happen so that there is a connect with the community, but it is not mandatory that the people have to contribute. The company that has done this, they have to undertake these activities. The company can look into that. The people don't necessarily have to contribute. So the answer here is A. One of these statements here is correct. The other one is wrong. If you want, you can take a screenshot. This was about Campa funds. The next topic that we have here is about India's tea industry. India is anyways a tea loving nation. All that's pretty unique. If you travel the world, you will see India is one of the very few countries in the world where we make tea with milk. In most other parts of the world, when you ask for tea, when you drink tea, there will not be any milk in it, it will be black tea. So this is very slightly different. Now, by the way, this is not why it is in the news. It is in the news because we have been seeing a lot of increased import of tea in India from Kenya. Now, if you look, India is the second largest producer of tea in the world after China. Kenya also produces significant amount of tea. But what we are seeing is that Kenyan tea, because of the cheaper price, is being imported into India in large numbers. And this is where our market is suffering. Our producers of tea are not happy with this because they are facing a tough competition from the Kenyan tea. In fact, the Kenyan tea import has surged to over 288% in 2024. Again, we produce much more tea than Kenya, but we consume a lot of tea. That is why a lot of tea has been coming into India from Kenya as well. The reason, as I said, first, lower cost, significantly cheaper. So it's much more attractive for the investors. They would want this tea, and it is mixed with the more expensive Indian tea. So it's not the 100% tea that you will consume, it's mixed up with the more expensive Indian tea. There's a big quality difference, and not just Kenya. Kenya and the nearby countries in Africa that have tea. For example, Burundi, Uganda, Tanzania, Malawi, all of these produce tea. So there's an auctioning method that takes place here called the Mombasa auction. This Mombasa auction in Kenya and nearby countries is where the investors can buy tea at a much cheaper price, and then that tea gets imported to India, which is something which our investors and our tea producers are not happy with. This is how tea is grown. These are the conditions that are required for growing of tea. These kind of questions are very commonly asked. They will give you certain climatic conditions and they'll tell you which crop is best suitable for these conditions. So for tea, you need to have optimal temperature range 16 to 32 degrees Celsius, adequate rainfall, 150 to 300 centimeter, requires 5 hours of sunlight. There's ideal humidity that is required. Soil should be acidic with a pH range of about 5, so slightly acidic, not very acidic. It is grown in hilly terrains especially. You will see tea plantations from very far away, like for example Assam, Kerala. These have significant amount of tea plantations in the country. Now if you look at India's position globally and within the country, the position of different states, as I said earlier, India is the second largest producer of tea after China. In India, Assam alone contributes over half of our tea production. And then there are states such as West Bengal. So in West Bengal, Darjeeling, for example, then Tamil Nadu, Kerala, they also have tea production. India also consumes a lot of tea. That is why 80% of our total tea production is consumed in India. And then it's exported also to other parts of the world. UK, Iran, Russia are the countries where our tea gets exported. But as I said, it's a very unique concept of having milk in our tea, which is unique to India only. You go outside, most of the countries that drink tea, they do not have milk mixed in the tea. It's just their, what we call as black tea is their normal usual tea. Now in India, specifically if you look at the tea production, the reason why it has been imported from Kenya also is that our tea production has also reduced. It has dropped down in West Bengal, it has dropped down in Assam as well significantly. There is a loss of premium products. A lot of premium products, premium tea actually is exported from India. And it's not just this. Fruits, vegetables also, a lot of best quality products that are grown in India are first of all exported because they earn a lot more money by export. And the remaining ones that are not of export quality are usually then kept in India. There is a decline in the export market as well because of the loss or because of the reducing production in India. There is also the issue of pending subsidies from the tea board. So we have a tea board of India whose responsibility is to make, to basically undertake research, etc., to help the tea growers in the India, to help the tea industry. They have announced a lot of incentives, a lot of subsidies for the tea growers in India, but the release of subsidies from the tea board to these tea manufacturers has not been on time. There has been a lot of delay in this transfer of subsidy, because of which again the production has got reduced. So it's a vicious circle. Lower production means lower output. They are dependent on this Tea Board of India to give the subsidies to them. They have not been doing that. They say that we don't have enough funding from the side of the government. All of that now culminates into a situation where your tea production is declining, leading to a surge of tea coming in from other countries. Now, if you look at how we stand globally in terms of production, China controls almost half of the world's production of tea, almost half. Then comes India, then comes Kenya, then comes Sri Lanka. On the other hand, if you look at the export, which country exports the most tea, we are very close to China. Kenya, although, is the one that exports the most tea. The reason being, although they produce much lesser than India, but first their population is much lesser, so they don't consume that much tea, and tea is not a part of their culture as in India is. Like in India, in most of the households, having tea twice a day, in fact even thrice a day in some households, is just a norm. In most countries, that is not how it works. So in Kenya, even the production may be lower, the consumption is not that high. First, the habit is not like India. Secondly, the population is not at par with India. So their tea demand, the consumption demand is not that high. That is why they export most of it. So don't be confused. While the biggest producer of the tea is China, the biggest exporter is Kenya, because their own consumption is not that high. The authority that we discussed, the Tea Board of India, is responsible for undertaking research. It has 31 members on the side of the parliament. Tea producers, brokers, all of these are members, and the board is constituted once in 3 years. They work under the Ministry of Commerce and Industry. There are many different boards like these. There's the Cotton Board of India, there's the Spices Board of India as well. So there are different types of these boards. It is not very unique. They work under Ministry of Commerce and Industry. The idea is to undertake research and production of tea. Any new method that has come up, they try and suggest how to improve the tea production going forward. Headquarters is in Kolkata, and this is what they do. They provide financial technical assistance, undertake research and development, promote efforts to brand our tea across the entire world, so that the demand for Indian tea mainly increases. They have done a good job. At least Indian tea is something that is demanded around the world. So this is where we have been working well. These are certain numbers about India's tea export. Total tea export to different countries from India has been improving, but again we are much below as compared to countries such as Kenya, China when it comes to export. Sri Lanka also exports a lot of tea, because again we do make a lot of tea, but our consumption, our population now makes sure that a lot of it is consumed in India only. Other countries usually export their tea outside. Let's see if we can answer a few questions from this part. Read it carefully. Think about what the answer should be. Consider the following statements regarding tea production in India. First, Assam is the only Indian state where both CTC and orthodox varieties of tea are produced in significant quantity. That is correct. CTC is a process of producing tea, that is called CTC. Assam is the only one where this kind of a tea is also produced in significant quantity. Darjeeling tea has been granted status of GI tag. Yes, Darjeeling tea very famous. It is exported in large quantity as well. India's largest exporter of tea in the world? No, we discussed it's Kenya, then China, then India. India is not the largest exporter. 1 and 2 are correct. A would be the answer here. A would be the answer. India is not the largest exporter. CTC stands for crush, tear and curl. So it's a method of producing tea. It's considered higher quality. It is difficult to grow. It is in demand in many parts of the world, the CTC. But in India especially, it is again something that is grown in smaller quantity in most of the states. Only in Assam is it grown in significant quantity. One more practice question, see if you can answer this one. With reference to tea cultivation in India, consider the following statements. Number 1. Tea requires temperatures between 20 degree and 30 degrees Celsius for optimal growth. That is correct. We did discuss the conditions required. A well-distributed annual rainfall of 150 to 300 centimeters is ideal for tea cultivation. Yes. It requires highly alkaline soil. No, we discussed it requires slightly acidic soil. Not much, slightly acidic. Acidic, alkaline depend on the pH level. pH level below 7 is acidic, above 7 is alkaline or basic. So it requires pH level of around 5. So it is slightly acidic, that is the ideal soil that is required. So third would be wrong. A would be the answer here. A would be the answer in this particular case. This is the explanation part if you wish. There is a previous year question. Let's see if we can answer this. This is the kind of question that can be asked about crops. It was asked in 2020. The crop is subtropical in nature. A hard frost is injurious to it. Requires at least 210 frost-free days and 50 to 100 centimeters of rainfall for its growth. A light, well-drained soil capable of returning moisture is ideally suited for the cultivation of this crop. Which of the following is that crop? See, sugarcane requires much more water. We discussed about tea also. Tea also is not matching here. They require much more rainfall. The answer here is cotton. It is cotton actually that is well suited for this. This is how cotton usually grows in black soil in India. So these kind of questions about different types of crops, etc., are asked time to time. So do pay attention there as well. With that, that brings us to the end of our session. I really hope you learned a lot of new things today and you were able to revise it as well. We have one more class remaining for economics, that will be tomorrow. So do join us again at 12 to make sure that you practice and revise all the current affairs that have been in the news. We have had 12 classes before that. This was the 13th one today. So in case you missed out on any of those, please try and go through those, try and revise that. That will be extremely helpful for you. My name is Harshmeet Singh. I'll see you tomorrow here live at Narayana IES Academy at 12 p.m. Thank you so much. Bye-bye. Jai Hind.